historically, you talked about between 2000 and 2010. I remember being around back then. So, it doesn't mean that things don't go up and things don't work.
It was a great
But
period for the TSX.
yeah, exactly. No, let's.
Because if we are seeing commodities take off, should be good for the TSX, not for global growth and what's going to get hammered. And remember, we're potentially seeing a repeat of the Iraq invasion 2003. Commodity prices pushed higher. We're seeing, history repeats. The problem is humans don't learn the lessons.
Hi, it's Ggoernert, Senior Investment Advisor, Canaccord, Genuity Wealth Management, and Geoernert Wealth Management. Now, welcome to the channel where we help you make sense of your financial world. Now, today, I'm going to be joined by Canaccord Genuity Technical Analyst, Javed Mirza. Javed, how are you?
I'm doing well, Greg. Great to see you again.
Oh, it's great. I really, really appreciate you joining me. A lot of it has been happening in the markets over the past little bit, and you've been doing a series called Weakening Goliaths, and you're just talking about a 4-year reset. I just want to talk a little bit more to you about that. What do you see in the markets right now? You see, from last work that you did, you kind of see us at the tail end of a short-term correction stage here.
Yeah, so basically, for those who follow our regular weekly notes, over the last couple of weeks, we said markets were preparing for a short-term corrective phase that was going to last 2 to 4 weeks, and that was going to undercut the March lows. And the reason we said that is because we saw the Goliaths, or what we deemed the 8 mega cap stocks in the U.S., were poised to head lower, and they had weakening technical profiles. And at the start of the year, one of the things we advised our clients, including the advisors here at Canaccord, was that the 8 Goliaths were likely to underperform the S&P 500. So S&P 500 year to date is, I think, down around 13%, and the Goliaths are down around 23%. So far, that call is working out. We're seeing a bounce here. Today is May 3rd. Tuesday, we got the Fed meeting tomorrow. And what we're seeing here is a short-term counter-trend bounce attempt to take hold. But everything that we're seeing suggests that after this bounce, which could last a week or two, is done, we're likely to have more downward motion towards the summer months. And we're going to continue to see choppiness through into the summer.
Yeah, I mean, this year, I think this is probably one of the worst starts to the year, over the past, number of years. I think we're down 13% to date. Yep. So how do you see things playing out for the end of the year? What other things are we looking at? We're looking at the gold, and where can people hide right now? Where would they be looking at, and how is this setting up for a future? Because I know that you've got 2 scenarios on your mind of how this is going to reset.
Yeah. So for those of you who have access to the webcast you and I have done, you'll see this is consistently what we called for since October of last year, that this 4-year cycle reset, basically the contraction phase of the business cycle. So this was our call at the start of the year, and so far it's playing out pretty well. The only thing was we were much more optimistic at the start of the year, even though we knew this corrective phase was coming. We thought it would be, down around 15 to 20% and last around 34 weeks. The issue is with commodities running and yields running higher here, we've got the real risk of stagflation. So if that continues, and we'll get a better idea this summer, if that does continue, then there's the real risk of stagflation. And what that means is right now, the correction that we're seeing, the magnitude and duration could be doubled. So if that's the case, then we're halfway through. The equivalent would be the tech bubble in 2000, 2002, which means that if we get to the summer and commodities and yields continue to rise, then we probably have another 6 to 9 months of downside and probably another 15%. So, peak to trough, we could see a 30 to 40% correction in the major indices.
Yeah. Okay. That's a big pullback. Now, we talked a little bit about stagflation there. How are you modeling, higher commodity prices, particularly in the oil complex, the energy complex, and higher interest rates? How are you modeling things through? Because I know you've got a couple of very specific scenarios, and I know you just touched on them there. But what are we particularly looking for in the summertime here?
Just where those things stand. So we're looking at a couple of indicators, the percentage of stocks that still look good technically, investor sentiment, CBOE put call ratio, a variety of different indicators. And if we see a major low develop this summer and it holds, then that is a good sign that we remain in this secular bull market. Remember, that's been our call since 2011, that we're in this secular bull market that has upside out into 2030. The problem is, if we continue to see weakness, then instead we're going to enter a secular bear market, which is essentially a 10-year sideways trading range, which is what we saw from 2000 to 2010.
Yeah, yeah. So yeah, there's been a lot going on right now, and then now that we're at the tail end, off the bounce, what kind of bounce do you think we could get right now?
5%.
5%.
Up to the 50-day moving averages on most of the
that
major
makes sense
indices
too.
here. Yeah.
So here, looking out, when would be? I guess we just got to look things through and see where we're going to be in the summertime here. So
basically, that's it. Like I'm taking a wait and see attitude. I'd be looking this summer in, call it July, August. We'll see how things play out. I think that should offer somewhat of an attractive longer-term entry point. But once again, right now, I need to see how things are at that point, and that will give me a better idea of whether it's going to be a major low or there's more downside. And remember, Greg, you follow my work. I have no hesitation in putting buy stocks right on the title. We did it right basically at the pandemic lows, and then the week before the low in 2018. So no hesitation in making that buy call. But right now, I still have a lot of hesitation. So what we're seeing right now is a low, but not the low.
Right. Yeah. So historically, you talked about between 2000 and 2010. I remember being around back then. So, it doesn't mean that things don't go up and things don't work.
It was a great period for the TSX.
Yeah, exactly. No.
Because if we are seeing commodities take off, should be good for the TSX, not for global growth. And what's going to get hammered. And remember, we're potentially seeing a repeat of the Iraq invasion 2003. Commodity prices pushed higher. We're seeing, history repeats. The problem is humans don't learn the lessons.
Right. Well, what's the phrase? The history.
Those are doomed to. Right.
Yeah, exactly. Or history doesn't repeat, but it does rhyme.
Yeah, exactly. So.
Yeah, no, and it makes sense because there's fundamental factors underneath that will drive commodity prices, and I know our friends in Calgary are probably the most upbeat I've talked to them in the past 5 years, I think.
Yeah, it's nice because normally when I've headed out there, they've it's not been great, but it's nice to look. Markets move in cycles, all this stuff, everything. Fashion moves in cycles. And right now, that's why I want to reserve my judgment, because I'll have a clearer idea. Because the point is, if this new cycle does take hold, it's not going to last 6 months or a year. It's going to be 3 to 5 years, right? So I'd rather have a stronger idea and more clarity, which is we're going to find out this summer. Yeah.
Okay, that makes a lot of sense. Well, thanks for dropping by. Awesome seeing you again. And
always great chatting with you, Greg.
Hey, thanks very much. Javed Mirza, thanks very much. Bye. Thanks for watching. If you want to see more content like that, please consider subscribing or join me on my website, ggoernert.com. That's ggoernert.com. Look forward to seeing you there.